reducing your insurance premiums. This is the coming up to, I think, the third or fourth last episode or part of our insurance series, the Advice Gallery webinar series. And I wanted to tackle this one because, there's no denying it. Insurance is very expensive. It has not gotten any cheaper. And it's getting dearer every year. We're seeing 15, 20, 30% increases on insurance premiums in any given year. And it's really frustrating. It's really hard for people to try to make ends meet when costs are going up at such an extreme rate. But at the same time, it's something that's really important. And there's no real way often that people can get rid of the insurance. You've got the insurance for a reason. It's not an optional or voluntary purchase. You've got it because you are carrying protection for a debt or to replace an income, as we've talked about in previous episodes. So you're stuck with this product that you need, and it's getting really, really expensive. So what I wanted to talk about today was what's driving those prices, how are insurance premiums actually priced? And it's a very high level because there are so many variables that affect insurance pricing, and I'm not an actuary, so the actual insurance companies will have a far clearer idea of exactly how the pricing is being generated. But I'll talk a little bit about what's driving them, talk about the variables that are within our control and that aren't within our control, and then have a bit of a look at some ways you can, so some broader ways that you can tackle those premiums and manage them in a way to make them a little bit more affordable for longer. Because a lot of the insurances that you've got, like I say, you may very well be in the position where you have the peak need of insurance now. And hopefully if you can hold it for just a little bit longer, the need will diminish, and you'll be able to start reducing the cover, even to the point where you can eventually cancel it. But you don't want to be in that position where you're having to cancel a policy outright for cost purposes, and then be, hit with something that maybe you could have claimed on. So I'll talk about how you can reduce it, and then we'll hop into a case study, a gentleman named Luis, and talk a little bit about 3 things that he did to reduce his premium to show you what that would look like, and then talk about sort of final steps from there. So we'll hop in. Okay, so I'll try to go with a bit of a weightlifting motif through the series, through this episode, because, what we're talking about here is the weight that people are carrying in managing their insurance. And how can we make that weight even lighter or reduce the amount that he's carrying? So how can we make it feel lighter, but also how can we reduce how much he's actually carrying? Now, the usual disclaimers, but I do want to emphasize again that the general advice here is really important. What I'm talking about today does cover some things like reducing cover, removing extra benefits, and doing other things to reduce the cost. All of these steps come at a compromise. They will reduce the amount that you'll get paid, they'll reduce the quality of policy, they will reduce things that you currently hold. So doing these things, making these choices are very, very important, and they can be very damaging if you make the wrong choice for the wrong reason. So do not do anything based on this presentation. Please obtain professional advice from us, or I'm more than happy to refer you to somebody who can help you on a commission basis. Reducing cover, I've met people where they've just cancelled their cover and then they've had a medical event. They were fine, they got back to work, but they can't get cover again. So just be very, very careful. You've got to tread very, very carefully when you're fiddling around with existing policies. Okay, quick overview. You've got life insurance, TPD, trauma, and income protection. We've gone through this slide a few times. Life insurance pays out if you die. TPD pays out if you're disabled. Trauma pays out if you're diagnosed with a critical illness. Income protection kicks in when you can't work for a prolonged period for medical reasons. So 4 different types of cover. We've talked about how you can own it. We've talked about how you can calculate it out. So I wanted to hop into, again, I sort of drifted away from the weightlifting thing because it's a dog in a jacket between 2 semi-trailers. You can't top that. So I wanted to quickly talk about sort of what drives the price for insurance. So at a baseline level, insurance premiums are really just a way that the company quantifies or puts a dollar value on the risk they're taking on. So if we step back even further, insurance is risk offsetting, offloading. I pay a company to take away the financial impact if X event occurs. It's actually a really innovative product, historically, and it's a really great way to enable people to take on extra risk. But in doing so, the insurer needs to be able to measure risk. And we've talked a little bit, I think, during the fundamental series, that risk, from my perspective, and I think from the perspective of an insurer as well, is the likelihood of an event occurring multiplied by the impact of that event occurring. So I'll talk about what that means in a moment. Insurance premiums are also based on the economy. So I don't know if people maybe you're familiar with this, but each insurer, but under the Insurance Contracts Act, they collect the premiums. Those premiums are then put into what's called a statutory fund. Statutory fund is regulated and legislated to only be invested in really low risk securities. So we're talking cash, bonds, incredibly low risk, because under the Act, they need to show that they can meet their obligations. So if, I don't know, if some huge percentage of their policyholders died, the insurer needs to be able to show they have the liquidity and the financial strength to meet those obligations. Now, the issue with a statutory fund, though, is that it can't be invested in anything that grows over time. So it means it's essentially completely hostage to interest rates. So on an economic perspective, as interest rates go up, the returns on things like bonds and low and fixed interest securities goes down. So what we've had in the last couple of years, anybody listening to this that has a mortgage can attest to this, interest rates have been going up. As they've been going up, insurers have been making less and less money on the statutory fund. To bridge that gap as they're bringing on new risk and new policies, they've needed to increase prices. Now, I will say, with a tinge of cynicism, that tends to only go one way. And when interest rates start getting cut, sorry, I've mangled this. For a few years, the interest rates were very, very low, so they weren't making very, very much money on the cash portion. So then as interest rates went up, everything else dropped as well. So they've shown some pretty poor returns there. So they've needed to top up their money, top up their profits by charging higher premiums. Speaking of profits, that's another aspect. These are companies. They are, set up to run as no profit, most of them. So they will determine what level of profit they're willing to make, and the commercial decisions they make around that will involve which markets they want to play in, what kind of pricing they want to use to buy market share, things like that. You're then looking at the actual structure of your premiums. And this is where we have spoken previously about these, but stepped versus level premiums. Stepped premiums, if you may recall, start off cheaper. So they start off, say, at 1 times. As you get older, though, they increase in line with indexation of the benefit. So if you had $1 million, the following year you have $1.03 million. So your premium goes up by that 3%, but it also goes up by an age-based increase. Because you're a year older, you're considered a year riskier, and so your premium increases. So it's really, really good when you're really, really young, but as you get older, it really becomes a very exponentially climbing premium. So stepped premiums start off cheaper, get really dear. Level premiums start off dear, but they don't have those age-based increases. So they won't increase at the same rate. And the idea is that if you're going to have an insurance policy for a long period of time, a level premium can often be a good option because it won't become unaffordable when you're in your 50s and 60s when you're going to need it. This is the theory. As I have perhaps alluded to in previous episodes of this, that theory has been severely undermined, often by some of the insurer steps. Some of the things the insurers have done have made level premium a little bit less attractive. But if you're in the first 10 years of your insurance policy and you started on a level premium, you would notice that price is quite a lot higher than if you were to go and jump to a stepped premium. Again, this is where we start touching on advice, because that decision, while appealing at a simplistic level, can have really long-lasting consequences. So be sure to get advice around that. But they're the kind of the 4 main drivers at a headline level for what's feeding into insurance premiums. It's the insurer's assessment of risk, which is based on likelihood and impact. It's the economic picture, it's their profit, motive, and pursuit, and their structure, or the structure of your premiums. There's a lot more, obviously. I'm trying to summarize it pretty simply. Now, if we move on to this idea of risk, I'm going to focus on this one today because the other 3 are fine, but there's not too much we can do about them. But if risk is the idea of this likelihood multiplied by the impact, what we need to talk about is what feeds into a likelihood and what feeds into the impact. So we'll start with likelihood of claim. The insurer, when they get your application or your proposal, they're looking at it and they're saying, what's the likelihood that this person is going to claim on the cover they're applying for? Now, contrary to what a lot of people think, that's not so the insurer can avoid paying the claim. It's so they can price the claim, price the policy. Because each person under a retail underwritten insurance policy is priced individually. So, depending on the risk that you're bringing to the table, you will pay a different premium. And that's all based around this likelihood. The higher the likelihood of a claim, the higher the premium. In the meantime, if you are somebody who's had your insurance policy for a while and you're noticing that the premiums are increasing, it is also worth noting that an increasing likelihood of claim will lead to a growing premium. And we'll hop into, there's a whole range of medical aspects to insurance considerations and claims, but a key one is mental health claims. In my time in working in advice, and I've started, I think, 19 years ago, mental health claims on income protection and total permanent disability insurance have shot through the roof. And that's kind of a reflection of some really positive things in that we're getting better at diagnosing mental health, we're getting better at talking about mental health, and we're getting better at recognizing mental health. But it is driving a huge portion of claims. So you're seeing mental health now as the largest cause of disability. Insurers are trying to find ways to, how do I put this? Mitigate the risk that mental health is posing into their book, particularly their income protection policies. So an income protection claim, something happens, you're on claim for a period of time. Often what they're seeing is mental health will deteriorate during that period, and that will extend the claim. And each claim that's extended, each extra month is costing the insurer money that they weren't paying 10 or 20 years ago. So it's a really big area of focus for insurers. In my career, what that has meant, though, is that we see a lot of people that get what's called a mental health exclusion. So you will just not be covered for mental health, which I can understand from a risk assessment and risk pricing perspective. But they do so, and if anybody watching this has a mental health exclusion, you'll have noticed that they kind of exclude you from everything from, very, very, very mild depression, sadness and depression triggered by severe grief, all the way through to, personality disorders and schizophrenia. Everybody's getting lumped in the same bucket. And personally, I'd like to see a bit more granularity around that, but we're a ways off there. But anyway, I digress, climbing up on my hobby horse. So what we're looking at with the medical risk is as those medical risks are changing or increasing over time, that is affecting the pricing of policies. So if you have an income protection policy that's more than 4 years old, you will be noticing those premiums are increasing. They're escalating very quickly. It's because those policies had a really broad, high quality, high breadth contract in place that covered a lot of things and provided a lot of benefits around things like mental health. The policies you can get now don't have that breadth. They are simply not as good, but they're cheaper. So you're seeing a bit of to and fro there. But it's worth looking at, they're looking at your risks of cancer. They're looking at your risks of heart attack. They're looking at your risks of musculoskeletal injury. They're looking at your risk of disability. They're looking at your likelihood of death, of not being able to work. And feeding into this idea of trying to measure that likelihood, there's a whole range of other factors as well. So you've got your occupational definitions. So it's quite natural to people on my side of the fence, I think, but for people that are not familiar with it, there are different definitions of risk in your occupation. So you've got blue collar workers. So blue collar workers are your tradespeople, people that are on their feet all day, people that are doing manual labor. They are considered higher risk, particularly for musculoskeletal things. And it's because not only is there a greater chance of them injuring themselves or just being hurt, that injury or hurt can knock them out of their occupation a lot easier. So for instance, I'm a financial planner. I spend all my time at the desk. If I were to break my leg, I can still do my job. If I was a bricklayer, like Luis, who we're going to meet shortly, and I broke my leg, I'm out of work for 3 to 6 months. Like I'm just not working. So that's where we're playing with that impact and likelihood aspect. Within blue collar, you've got dark blue, blue and light blue, different levels of severity of that manualness of the labor. And there are some occupations that insurers simply won't cover. So airline pilots are a really good example of that. They have a lot of trouble getting cover, if any. If you work in a mine, if you work underground, if you work with explosives, it's going to be next to impossible for you to get cover. If you're working in an unqualified heavy-duty trade, so if you're an unqualified bricklayer, if you're in demos, if you're doing really, really heavy work, if you're a line worker in a factory, it can be really, really tough. Compare that to white-collar workers who have their own individual risk profile. Lower likelihood of injury, lower likelihood of that injury keeping them out of action, but a higher likelihood of illness having a disproportionate impact, particularly mental health. So you're seeing this interaction there around occupations. Then another factor that feeds into your likelihood of claim is your age. The reality is that a 25-year-old person is a lower likelihood to claim for cancer, heart attack, or stroke, kind of what's called the 3 big ones for trauma, than a 60-year-old. On the flip side of that, though, the way life expectancy works is that as you get older, your life expectancy tends to increase. It's kind of a weird thing. On the tables, it doesn't. But the likelihood of a 70-year-old living longer than a 50-year-old living longer, mathematically, is kind of a bit sketchy. So age is a factor. Another factor is gender. Men pay more for insurance. They just represent a higher risk cohort. I will avoid making any comment on why that might be. I think we could all assume. Yeah. I think traditionally. So a lot of this is based on historical data and research. Your medical history is also going to affect your likelihood of claim. Medical history and medical reality. So if you have a history of high blood pressure or high cholesterol, or if you have a portion of your family that have had diabetes and are diagnosed before the age of 60, this all feeds into the equation of how much risk you represent to the insurer. So high blood pressure, high cholesterol will often lead to a loading on the premium. There could be a 50%, 100% loading. Sleep apnea can lead to a loading. Back injuries can lead to an exclusion on the policy. All of these factors represent that risk profile of you for the insurer. So your medical history and your medical current situation, so height and weight, you can't do much about your height, but if your weight's really high, your BMI is really high, the insurer is going to charge you more money for the cover because you represent a higher risk to them. Then we've got the impact. So you've got the likelihood, the chances of these things occurring, and then you've got the impact of if they do occur. And the primary one here, obviously, is the payout amount. The benefit amount the insurer will be on the hook for. So the higher the benefit amount, the higher the premium. Fairly linear. If you wanted $500,000 of cover, all else being equal, somebody paying $2 million of cover who's exactly the same as you will pay a lot more. Now, there are discounts that apply. There's some size-based discounts. We have a lot of clients that need like $470,000 of cover or $960,000 of cover, and rolling them up to $501,000 or $1,001,000. You get a discount for that often because you have more cover. But generally speaking, larger the benefit, higher the premium. The other impact the insurer is looking at is what's the duration of payment they're up on the hook for. And this primarily relates to income protection. It does relate to trauma, it does relate to TPD in a bit, but it's primarily income protection because when they're underwriting you, they're looking at the likelihood of you going on claim and the likelihood of how long that claim's going to last for. So a lot of income protection policies in the market some still do, used to pay you to the age of 65. So I took out my income protection policy when I was 26. At that time, had I have gone on a permanent disability claim, the insurer is on the hook for 39 years of benefit payments that are then indexed every year, that also escalate every year with inflation. So that represents to them a significant risk. So that plugs into the calculation of how much risk I am, because at the same time, I'm young, I was young, I didn't smoke, I still don't smoke. I had all these things going for me. But it's just a different risk profile. So the longer the duration, the longer the premium as well. So, some quick equations. If premium equals the value of the risk, the dollar value of the risk, then risk equals the likelihood times the impact of that occurring. Then for an insurer, likelihood and impact do drive premium. That's how they balance the equation, because the higher the risk, the higher the premium. A point worth making here is the retail insurance policies that I use, so the ones that we recommend. They're not general insurance. They're not group insurance that you get as a default through your super fund. They're not something you can buy on TV, daytime TV afternoons or anything like that. These policies are individually underwritten, which means that you are assessed by a company for your individual risk profile. The company will then make the decision on whether or not to take you on as a risk. If they do decide to take you on as a risk, these policies are what's called guaranteed. They offer guaranteed future insurability. Guaranteed renewable. What that means is that once they've accepted you and once you've paid your premium, so long as you keep paying your premiums, they cannot cancel the contract. So if they're organising a life insurance contract for someone at 21, they are essentially taking on the risk that that person will stay on their books all the way through and they can never cancel it. So they're trying to forward assess the risks embedded in that person's life based on sort of assessments they're making now. And there's a trade-off for insurers, because if they could ask you 1,000 questions and get a really specific and really granular picture of your risk profile and probably charge you a little bit less. They'll probably be able to tailor the premium to your individual circumstance and you will probably end up paying less. But it'll take you about 3 years to get the cover. And they would know every little big thing about you. At the other end of the spectrum, they can ask you 2 questions, charge you a fortune for it because they just don't know what the risk is, but still put you on the policy. So you see that with some of the bigger superannuation policies traditionally. They will take on these risks at a blind level and just hope that their calculations play out. Insurers are trying to strike a balance in the middle where they're asking enough information to make a reasonable assessment, but not so much that they blow out the system. Which brings us to the idea of managing the cost of your insurance premium. So I'm going to assume that people currently have insurances, that you currently are paying the premiums, you've opened your renewal notice, you've sworn, and now you're trying to work out what you're going to do about it. So there's a few different options. Number one is reduce. You'll see here that they've gone from a 5 kilo dumbbell to a 2.5 kilo dumbbell. I said at the top of this to be sure you get advice. I want to emphasize again, be sure to get individual financial advice before you make this decision. Because the number one way you can reduce your premium is reducing the benefit. It's almost linear. It's divide the benefit by the premium, it'll give you a factor. If you reduce the benefit by X, multiply that by the factor, kind of gives you an estimate of the premium you'd be paying, kind of. So lower the benefit, the lower the overall price, which makes sense because as your life changes, you might pay down your mortgage, you might get a pay rise, you may accumulate more assets, more savings, more super. The argument for reducing your benefit over time can be quite a solid one. However, there are risks and downsides here. Once reduced, if your health situation changes, if your occupational situation changes, it can be very hard to come back up. You have to reapply, reassess, re-underwrite. The other thing is you may take out new debt down the track. So quite often we're seeing people clear down their mortgage quite a lot using a redraw offset facility. Then they yank that cash out and they buy an investment property, which they've geared up again. Now, they may not want to have to sell that if they get sick, so they may still need that insurance. But if they've reduced it a few years beforehand, they're in that position where it's hard to get it back up. So, all of the processes, all of the options I'm going to present today around reducing your premium involve some sort of compromise. You will be giving something up in order to save that premium. And so this is what this is. You're reducing that benefit. So just again, seek advice. Another option is to remove. So our 2.5 kilo friend is gone. And by remove, I mean you can remove the optional extras that are attached to your policy. So quite often, a good quality policy will have optional extras added to it. Now, one of the challenges advisors like me find in providing insurance advice is that there are 60, 70 individual variables that play into how much insurance costs. And included in that are all the different optional extras you can add to it. So for an income protection policy, you can add on an increase in claim option, where the monthly benefit every year increases in line with inflation. Because if you're like the 26-year-old me, but you're going to claim at 28, you don't want to still be receiving that same dollar amount in 30 years' time. You do want it to increase. It's a paid extra. Trauma reinstatement. If you make a claim on a trauma policy for cancer, you can reinstate your policy that provide coverage for everything but cancer. It's a paid extra. TPD buyback. You've claimed TPD, you can buy back the life cover if that's attached to it. Again, it's a paid extra. So these are all really valuable. There's a reason they're paid extras. There's a reason people put them on policies, and there's a reason people like me recommend that people hold them. One of the challenges, as I was saying, is all those variables, we need to assess which ones are worth paying for, in our opinion, based on our knowledge of you and your circumstances. So my default would be to recommend increasing claim option. But if you're a 52-year-old person, low risk, that has a significant property portfolio, maybe you don't need that. Maybe in the event of a claim, you can sell off a couple of the properties, reduce the debt, you'll be fine. So there's a very tailored, very bespoke approach to insurance. But when you look at the prices of these things, they might be more expensive than you're really wanting to pay in this new world and the new level of need or situation that you're in. Another one is to update, change some of the things attached to your policy. Now, specifically what we're talking about here is changing some of the variables over which we have some control. So you can't, I don't want to tread into this kind of controversial territory, but most people aren't going to change gender. No one's changing age. Very few people tend to change kind of residential area. That doesn't play a huge factor into it. But there are some things that people can change that will have a direct impact on the price. And the number one really is your smoking status. So if you're currently a cigarette smoker, cigar smoker, pipe smoker, vapor, whatever it is most likely the insurer will be assessing you as a smoker. And smokers pay somewhere between, I think, 30 to 50% more for their premium. because it represents a higher risk. It is one of the biggest contributors to your increase of an individual risk profile is smoking. It's one of the more damaging things people will do. The common question here is, but what if I just don't tell them? I just have a couple of smokes at a party every now and then. If the insurer at claim time, if the insurer can prove that you were a smoker, they do not simply charge you the higher premium. So what some people have told me, okay, I'll take out $1 million of cover. I'll say I'm a non-smoker. I'll pay less. And when I go to claim, I'll tell them, whoops, I was smoking. They'll just charge me whatever the back premium was, whatever the difference was, but I'll still be ahead because I'll get the benefit. It's not how it works. What they do instead is the insurer will say, okay, so you've been a smoker the whole time. We will reset your level of cover to what the premium you were paying when you first got it would have got you. So instead of getting $1 million, you might have $600,000 of cover. So it can be a nasty surprise. In saying all of that, it's higher risk. If you change your smoking status and stop smoking, your insurance premium will drop. Now, it has to be, I think, 12 months plus a day of non-smoking. You have to make a declaration that it's true, knowing that if it's not true, you will wear the consequences later. But if you do that, your premium will drop. And we'll factor that into the case study we're about to hop into. Occupation's a big factor as well. So Luis, that we're about to speak about, is a bricklayer. If he had a change of career and he became a financial planner, his risk profile would drop. He would pay a lower premium moving from blue collar to white collar. He would end up paying a lower premium for his insurances because it's just a lower risk. You may have also improved your health. So if when you applied for the cover, you were on blood pressure medication or you had high cholesterol, you may have now gone 3, 4, 5 years off the medication, but still with really good results. You may have turned your health around. If that's the case, get your insurer to reassess your policy. Yeah, make the declarations you need to. It shouldn't deteriorate the quality of the policy you have. It should simply be a pricing factor. So that can be a significant drop as well. If you're paying a 50%, 100%, I've seen 200% premiums. So instead of paying $1,000 a year, people are paying, $2,000, $3,000 a year. Getting that removed makes a huge difference. Another interesting one is sports and recreation pastimes. The common one being, footy. If people are playing footy, they'll often have a longer waiting period or they'll have an exclusion. Sometimes they'll have a loading because, again, playing footy, you are at a higher risk of hurting yourself than a desk jockey like me. So depending on the pastimes, horse racing is another one. I think dressage for horses is one. Boating can be one. Scuba diving can be one. All these sports and recreation things that insert more risk into your life. If you've stopped doing them and you never intend to do them again, contact your insurer and get them removed, get it updated. So that's what we're talking about when we're saying updating your insurer. The other aspect you can consider is the way your insurance is structured. There's a few options here. So we've talked about premium structure, stepped versus level premiums. Generally, if you've started the policy in the last couple of years, you're probably going to be on stepped. But if you have been on a level policy, level premium, for the first 10 years, you will have been paying a great deal more than you would have on a stepped premium. The idea being that in the next 10 years, you should end up saving money. That may or may not be the case. Get it reviewed. You can have your payment change the way your payment is structured. So this doesn't save you money. You can move your life or TPD or income protection or all three into your superannuation, or you can have it paid for via your superannuation. This doesn't change the actual cost of the cover. It just changes the source of money that's paying for it. And there can be downsides. So if you've all of a sudden dropped a $5,000 expense onto your onto your superannuation, that's now $5,000 a year indexed and compounded that won't be there come retirement. So it's a really big decision to make. But if you are struggling to pay for it and you desperately want to keep the cover, this can be a compromise that will take that cash flow burden off your month-to-month pay. You can choose a frequency structure. If you have the financial means to, paying an insurance policy annually is going to save you between 7 to 8% a year. It can be a significant drop, if you're already paying the maximum each year. Excuse me. You can change the taxation structure. So what we're talking about here is, are you claiming tax deductions on your income protection, or are you asking your accountant about it? Are you making contributions to super to fund the insurance premium? There are some tax benefits in doing that as well. What they can do really is make a life insurance premium that's $1,000 in your own pocket effectively cost you $850 with the tax deduction. So there's some nice things you can do around that. How is the policy structured? So do you have 3 standalone life, TPD, and trauma policies that are all separate? If you do, you're probably paying 3 different policy fees. You're probably paying higher premiums. Those size discounts I talked about earlier sometimes can apply across multiple policies. So if you instead link them, I think the cold's getting me. If you instead link those policies, you can sometimes qualify for a size discount, which will bring down the premium. Now, again, there are pros and cons here, because by linking them, sometimes what can happen is you can end up claiming on a trauma contract and your life insurance benefit is dropped by the same amount. So it's kind of, you're saving money, but sometimes you're saving money by giving up benefits. So be conscious of that. And the other big one for income protection in particular is playing with waiting period and benefit period. There used to be more we could do, but when they changed the policies back in 21, kind of took some things away. Increasing your waiting, let me scratch that. The shorter the waiting period, so the faster you get paid, and the longer the benefit period, or the longer you get paid, the higher the price. So your options for waiting periods are 30 days, 60 days, 90 days, and up to 2 years. Benefit period is 2 years, 5 years, and I think to age 60. The longer you can push out the waiting period, the longer you can go without being paid, the lower your premium. Now, keep in mind that most policies pay the following month in arrears. So 30-day waiting period is really, you're not getting paid for at least 45 days, possibly 60. 90-day waiting period, you're not getting paid till day 115, maybe 130. So it's worth knowing that if you have the money behind you, if you have a partner with a high income, if your expenses have dropped substantially, maybe look at increasing the waiting period because it will drive down the price. This is an advice area though, because you are reducing the quality of your policy and you are putting yourself at risk of being financially without money in that period. Same with the benefit period. If you cut your policy back to a 2-year benefit period and you're 40, in theory, if you had to make a claim tomorrow, you're only going to get paid till 42. What do you do for the rest of your potential career? So it's a really consequential decision. So have a think about it, get advice. All right, let's meet Luis. How are we doing for time? Okay. Luis is a 46-year-old bricklayer. He smokes 3 packs a week, so he's considered a smoker, and his high blood pressure meant that he had 100% loading added to his insurance. He has $500,000 of life and TPD cover, $4,500 of income protection, and $200,000 of trauma cover. Make that $100,000 of trauma cover. I think that's what I base the calculations on. So this is what he's currently paying for insurance. Now, it's a lot of money. He's paying nearly $12,000 a year for insurance, $1,000 a month. I've realized in doing these quotes, I haven't included the 100% loading. So ignore that for now, because he's not paying $24,000 for insurance. But he's paying $12,000. $500,000 of life and TPD, $100,000 of trauma, and $4,500 of income protection on a 30-day waiting period, payable to the age 5-year benefit period, being a bricklayer. So this is maximum risk profile. So what I wanted to look at are what are some of the things we can do to try to bring that down a bit. Number one, he could just pay annually. If he had the money, he could pay annually. $11,129. He saves himself $835. Not in substantial amount, but it's not really going to move the needle too much. You'll also see, I think you can see as I'm flicking back and forth, the difference in premiums by paying annually. It does add up. He could extend the waiting period on his policy. So he could push the waiting period out by, I think I went from 30 days to 90 days. So he's currently paying $3,666 for his income protection. By pushing out that waiting period, he drops $869 off the price of that, making it $2,797. Remembering that income protection is in most cases tax deductible. So number 1 and 2, his cumulative saving is adding up as well. Where he makes the biggest difference, though, is Luis decides one day to stop smoking. Gives up the smokes. Immediately significant saving by doing so. So after 12 months and 1 day, he contacts his advisor and he says, look, I've stopped smoking. Where's the paperwork? Signs off on a declaration of continued good health that will say, I am no longer smoking cigarettes. Keep it an honest declaration, of course. We'll see the premium drop substantially. And you see it drops across most of the categories. Strangely enough, when I was running this through the quoting system, the trauma didn't change, which really surprised me. I'm not sure if that's accurate. But regardless, he's looking at a $2,100 saving there. So just to try to show what these 3 steps, and 2 of them are pretty simple. Stopping smoking, I've never had to do it. I can't imagine it would ever be described as simple. But what I wanted to capture here was just kind of the breakdown of what these compounding savings could do. So doing these 3 things, he ends up saving about $3,000 on his annual premiums. So it's not insubstantial. And like I'm saying, this is what a lot of advice now is around insurance. We don't like changing policies. One of the things you can do, and I think it has been a really fundamental part of insurance advice in Australia for a long time, is change insurance companies. So you could say, look, I'm with ABC Insurance. It's costing me 11 grand, like it is for Luis. But over here, XYZ Insurance is saying they'll charge me 9 grand. So I'll just hop over there. Completely makes sense, except by doing so, you are going to get reassessed. You're going to get re-underwritten. And if you miss anything in that underwriting process, or if you hide anything, or if you deliberately don't tell them something, that'll then come out. It comes out. You have a duty of disclosure to make sure the truth is provided. If they then discover it, which they will, you may not be covered for something. And there's a long list of cases through the ombudsman and through the courts where people have done exactly this. And then they weren't covered for that excluded event. And as always, Murphy's Law is that if you get an exclusion for cancer, or if you haven't told them something that they would have excluded you for cancer, you are then diagnosed with cancer, the consequences are far greater. So we're always reluctant to change insurers unless there's at least a 20% discount, a 20% saving, and it can match the same terms and features of the current policy. So I haven't included that in here as an option because it's kind of a pain. It introduces extra risk. And if you're just doing some of this admin hygiene, that can actually have a bit of a difference anyway without having to do that. So just by doing those 3 things, Luis is going to see a significant saving. Now, another item I wanted to cover, and this is really abstract. This is really out there. I mentioned the statutory funds before. So the statutory funds are these huge bank accounts, essentially. And insurers are tipping in your premiums in there every year. They take out their profits and they keep growing. They subtract the claims they're paying out and the fund should keep growing, becoming a machine that's just throwing out profits. Now, the collection of people that are putting money into that statutory fund, we call the insurance, the pool of life insured. Now, that pool in Australia is getting pretty narrow. It's getting pretty shallow. It's getting pretty old because a lot of younger people are not putting. The system worked when you had a pyramid structure where the bottom layers of the pyramid for younger people were providing all of this big chunk of premiums at a lower risk because they're a lower chance to claim. Their premiums are almost what's considered free float, free money to the insurer. That money was getting funneled in and it was going out to the claimants that are higher up on the pyramid, so the older members of the pool. The issue we have now, though, is that wedge of the pyramid is narrowing. Fewer and fewer people are contributing to the insurance pool because of pricing, because of things like that. As that narrows, the premium has to increase to make sure that the payouts that are coming out, they're pretty consistent. They still have to be made every year. And the only way they can do that is by squeezing the people that are left in the pool with higher premiums. Now, at an individual or at a micro level, the solution to this, if you've got the stomach for it, is just cancel your policy and not care about it. It's just the insurer, who cares? But at a macro level, the more people we can get entering the insurance pool, the more people we can get contributing premiums into the pool, the greater stability we should have in premiums. Because we'll take our policy holder wedge of the pyramid from being like this to being like that. And by being a much larger cohort, they need to contribute fewer dollars each to meet the outgoing and outstanding liabilities of the insurance fund. The reason I raise this, and like I said, it's very abstract, it's very, very much a macro thing. Talk to your friends about getting life insurance. The more people we can get out there just taking out even small life insurance policies. Firstly, they're protected, their family will be protected, there will be a financial reduction in the impact of them dying, being made disabled, falling critically ill, or not being able to work. So there's a benefit to them at a micro level. Yes, it comes at a cost, but at a micro level, it'll benefit them. At a macro level, if we can significantly move the needle, and I'm mixing all the metaphors today, but if we can move the needle of how many people are contributing into that pool, we should see stability return to premiums. We should see premiums flatlining a little bit. Now I'm talking thousands and thousands of new lives, not half a dozen. But I just want to put that out there, that the bigger the pool, the lower the cost. That's what we're working towards with this idea. And that growth is going to come from younger people, so people under the age of 40. The issue we have, of course, is that people under 40 are having to have huge mortgages, which are very expensive to cover, which the premium itself is very dear. We're seeing lots of cancellations at the top end. Insurance in Australia is in a bit of bother. Not trouble, but a bit of bother. But talk to your friends about insurance. It's always hard talking about money, but just say, hey, if you don't have insurance, get some, because maybe you'll save me a couple of cents on my premium. The other thing that we haven't talked about, and kind of an approach that you can use to reduce premiums, is commissions. And I've been pretty outspoken in the past around commissions. But just so you know, every insurance policy, every retail insurance policy in Australia has the option to have commissions on it. And that commission normally means that of the premium, 66% of that dollar amount will be paid to the person who places the insurance as a commission, an advisor. So if you've taken out $1,000 insurance premium, and you've paid $1,000 insurance premium, your advisor that helped organize that will get paid $660. On top of that, each year after that you keep the insurance, they'll get paid 22% of the premium each year. So you've got $1,000 premium. The following year, it goes up by 10%. You pay $1,100. Your advisor will get a 22% commission on that $1,100. And I think it's really easy to sit here and say commissions are bad. They're not. Right? So they are really important. They cover the cost of getting the advice prepared. They cover the cost of placing the cover, and they cover the cost of servicing the policies. Preparing a statement of advice for somebody around insurance, you're looking at minimum from go to woe 10 hours. 10 hours at a half reasonable rate is going to add up pretty quickly. You then have the issue of placing the cover, and actually getting the insurance placed is also super challenging, because it can be hard to get somebody underwritten. It can be hard to get somebody's medicals in. It can take a long, long time. And then once the policy is in place, commissions will often cover the cost of any claims. It'll cover the cost of maintenance and adjustments. And I'm a zero commission advisor, frankly, because I think the workload that's required in managing insurance is really hard to price on a commission basis. So commissions can be really, really beneficial, particularly for clients, particularly for policyholders, but they add 25% to an insurance premium. If you take that away, yes, your insurance premium drops by 25%. So your $1,000 premium is now $750. Fantastic. But you will have to pay for the work that's associated with that policy. And that's the downside. Getting rid of commissions, again, any way to reduce premiums, you're compromising on something. You are bringing in a cost somewhere else. So it's something to think about, but I can say that in Luis's case, removing them would have saved him an extra $2,200 off his premium. So he would have gone from $11,000 or $12,000 premium, pay annually, extend his waiting period, stop smoking, and then get commissions removed. He ends up paying $6,700 instead. So there are some ways you can manage your premium. In saying that, if 2 years from now he needed to make a change to his policy and I was his advisor, I'll do it for him, but we'll charge him. We'll send him a bill. If he goes to make an insurance claim, again, we'll do it for him, but there's a cost that comes to that. So it's kind of a give and take. There is the promotion. We have talked about this before, talking about commissions. Because we're a zero commission firm and we're waiving all advice fees, you're kind of in this short-term period where you can get us to take over your policy, turn off the commissions, not pay us for the service, and just end up saving 25 grand. So you kind of eliminated that downside that we were just talking about. Covered a lot of ground. What have we at? We're at 45 minutes. So I'll leave that here. I don't think there'll be any questions. But if you're watching this later, if you have any questions, please feel free to email us, hello@theadvicegallery.com.au, or give me a call on 0431 664422. There's a lot here, and I'm very conscious that people's insurance premiums are climbing. They're getting very expensive. But I'm I'm really uncomfortable meeting people when they've already cancelled their insurance, because very, very few people, particularly with a mortgage in Australia, have no need for insurance. So when I meet them and they've cancelled it, they've gone from sort of full price to cancelled. I'm just very conscious that there's a lot of interim steps in between that you can take that might make it a bit easier for you to keep the cover for a year or two or 3 or 4 extra years, just to extend that umbrella of protection for as long as possible. Hopefully this has been helpful. I will leave it there. Thank you so much for watching. And yeah, any questions, just reach out. Till next time, I'll see you later. Cheers.